question, you've got 10 seconds to answer. We can go into a bit more depth later on, but the first section, rapid fire, does exactly what we say. So 10 seconds to answer.
Do you not bring your own microphone?
Make it snappy, make it controversial.
Is it on?
Yeah.
Yeah, make it controversial. We'll be on cover of FT tomorrow. Okay, lads. Right, first question. Here we go. Do you think the tie should be brought back as part of the daily city attire? I feel like this is quite directed at you.
What do you think?
Rumour has it Michael actually sleeps in his tie.
I mean, Michael is probably the only 23-year-old that has the same opinions as a 75-year-old. So there's absolutely... He's definitely going to want to keep
It's
it
like the
tight.
reverse of like Benjamin Button.
I definitely do think he actually has a suit pajama waiting for him this
I
evening.
can confirm I don't.
All right. Jokes aside, inflation, arguably the big macro debate that frames everything we do. Let's turn to the US. Where is the CPI inflation rate by year end?
Let's call it 6.5%.
I reckon demand comes down a little bit quicker, so we'll see 4.5 to 5%.
I'm going to go with 6, or maybe I'll kind of sit on the fence with this one.
Okay, all right. Okay, quite low. Okay. Are the markets in control of the Fed, or are the Fed in control of the markets?
Tough one. Right now, the Fed are in control of the markets, but eventually the market will end up bullying the Fed.
Yeah, I think it's kind of hard to argue the market's kind of in control at the moment, considering how far we've kind of come off this year. But as Michael says, when the panic buttons get hit, then I'm sure the market will reassert itself.
I think if you've read anything by Zoltan Polzar, if you managed to understand anything he said, then he would probably have you think that the Fed are orchestrating all of this to get the wealth effect down and to get inflation down. Perhaps there's an element of that with the housing market. But yeah, I still think the Fed's fully in control, and they always will be. I don't think that the market necessarily is a good barometer of whether the Fed is in control or not. I think the economy matters a lot more.
Okay, Dave, very interesting.
That was a lot
there.
longer than 10 seconds.
You get the timer up then, timekeeper. Come on. All right, have we bottomed in equities and credit, or are we due to take a sinister turn?
Well,
No.
When we saw this question, we were kind of flummoxed as to what a sinister turn is. Is this, people eating their pets, riots on the street, or is this kind of a couple hundred points down from where we are?
Let's go for Morgan Stanley's 3,400 target as a sinister turn.
What if that's the Michael Wilson call? He's been right on everything so far compared to Kalanovic. So I'd probably say yes. I think it's fair to kind of think we're going to get a test to that. Yep.
Yep, I'm jumping on that bandwagon as well.
Yeah, I think if you see the rate of change of interest rates so far and how far the Fed really wants to go, interest rate risk in this market is probably paramount. So if they do end up going, up to 3.5%, I think, which is is that a terminal or neutral rate? I can't remember now. It's a terminal one, isn't it? Then we should see more sort of equity downside, I reckon, credit downside as well.
Okay, so obviously the next question, depending on the data, do you think the Fed pause in September or put the pedal to the metal and keep going?
That question wasn't in the notes you sent me. No, I don't think they will. I think they're going to keep their foot on the brakes. 50 bips, June, July, September, 25 for the rest of the year after that.
I think this is kind of emanating from one of the comments we saw from Bostich a few weeks ago, and I think it's been kind of a concerted effort from the Fed to kind of get in front of that and kind of correct the records. Yeah, I think we still keep going in September, but towards the end of the year, I think that's when things get a little bit more interesting.
Yeah, I think if you look at euro dollars, even today, if you look at the December contract on euro dollars, straight back down. So the market isn't really expecting, anything to pause or to change in terms of interest rates, in my view. Anyway, just from looking at it about 10 minutes ago.
Just one other thing.
on Trading View?
Yeah, we've got the euro dollars contracts there.
You got the live pricing or the delayed?
No, live. If you pay, it's only $4 for the COMEX. NYMEX CME stuff, so you should all get on that.
Right, so sticking with the US theme, the US dollar is obviously key to financial conditions. Taking a 1 month view, do you think the balance of risks are skewed towards US dollar going higher or lower? Take it away, gents.
That was very Bruce Forsyth. Play your cards right, wasn't it? Higher.
That's one for the international viewers there.
Yeah. Higher.
Okay.
Yeah, higher as well. I think, I'm just going to say higher.
I think considering if you're looking at the dollar index, the largest constituents of that are the euro, the yen, and the pound. I think it's kind of hard to really bet against that at the moment.
Well, speaking of the yen, you guys actually put out a very funny tweet that I chuckled at today about the Green Goblin and Spider-Man and the lira laughing at the yen. You know you're having a bad day at the office when the lira is laughing at you. So shorting the yen has been working very well of late. Do you think there is still some more juice left in this trade, or could we be reaching a turning point soon?
I think when it comes to the yen, I think it's kind of best to kind of look at it less in terms of outright levels, but I think it's kind of more the velocity of the move. So I kind of think if we extend from here kind of at this pace, then I think you'll see a more concerted effort by officials to try take it down. But in terms of an actual level, if we kind of keep grinding over the next 12 months, I don't think that's going to be necessarily as much of kind of a cause for concern.
I reckon 135 is going to be a key level. It's that high from, can't remember specifically when. Was it 2002? Yeah, so a 20-year high right there. That is very, very key kind of psychologically as well. So I think that would be I'm not going to give any trading advice, so I'm not going to say anything about that. But basically watch what happens around that high, in my view.
Yeah, I think you're right. I think that's a key level to watch. And I think, again, the reaction depends on the speed of the move rather than the level that we get to. And if we slow down and if we grind higher, well, why would you be long yen when the BOJ are as dovish as they ever have been?
Dovish this week.
Exactly.
Basically goes the green light to keep selling the yen.
I wonder what's going to happen with the yield curve control as well. Sorry.
Guys, that 0.25 cap on the
Yeah,
10-year
they're
they're
kind of trying to defend it, but it's almost signifying that, you know, one of their policies sort of could potentially break. It's quite a dangerous thing, and you know, I don't really think
they will
that.
change it.
Yeah.
And they will change it in December.
You think?
Yeah, I'm parking a number.
Is that just you throwing it out?
They will change it. They will change it this year.
Can I get the lottery numbers off you as well?
They are going to change it this year, and they will raise interest rates later this year to a token to get out of negative. But that's it. Then done.
Oof, well,
Ladies and gentlemen, I hope you've heard that.
You an
You're holding to
insider?
it.
One and done.
How many of those Peronis did you drink?
Right. Which central bank has the hardest job at the moment? ECB, BOE, within the G4 complex? Lads?
When I saw the question, I had a funny answer. I was going to say Russia. But Sam, I think this is kind of part of one of the other questions. I think Bank of England, I think we're kind of in agreement of that. I think they kind of need to be hiking into stagflationary environments. There's kind of like a real household income squeeze, and they're going to need to keep going. I think they're probably in a difficult space.
Yeah, I would agree. I mean, I slag them off as much as anyone else, but they do have a ridiculously tough job. You've got inflation at 8-9% is going higher, growth is non-existent already, and it's going to slow even further. So yeah, I think the BOE are in a ridiculously tough position, but that doesn't excuse Andrew Bailey telling people not to ask for pay rises.
Probably take a different stance there. I'll probably say the Swiss National Bank, purely because their monetary policy is so unconventional. You know, they've got a portfolio of about 160 billion in the Nasdaq. They're one of the top owners of Apple, for example. Now, what are they going to do with all of that cash? I mean, they kind of repatriate it and give it back to the cantons, which is basically like their counties. But they only started doing that about 2 years ago. And also, if you look at the franc, they've been trying to weaken it for years, but it's just not worked at all. So, you know, I'm not concerned. It's just I think from their perspective, it's like from a narrative sort of way of thinking. It's kind of like how do they keep going forward, and how do they withstand? You know, trying to say that their monetary policy is to affect the franc and weaken it when actually it's done the complete opposite.
Which central bank has the least amount of credibility and had to do the biggest pivot, and why is it the RBA?
Can you ask someone who gets up early enough to watch their decisions?
I think if you ask me this in 6 months' time, I'll say the ECB.
Yeah, I think just on the ECB, actually, it'll be interesting to see how the Swiss National Bank react to the ECB raising rates over the summer. Are they going to follow? Are they going to stand pat? How high do they go if they do follow? So actually, I think that's a good shout on your part.
Well, I think the obvious answer to that is the Turkish central bank, is pretty much an autocracy. And so, I think even this week or last week, Erdogan said we're not raising rates, even with inflation at, I don't know, is it something like 50, 60%? It's insane. He keeps wanting to cut rates. And I think there's kind of like a religious element to that as well, which makes it even, more crazy because it's almost like dogmatic rather than... No, I've heard that it's actually really expensive in Turkey. Yeah, I've heard that they've kept the prices going up. So
No, summer only goes to Bognor Regis anyway, so it's not relevant there.
All right, let's change things up a gear here. So crypto, Michael Saylor versus Buffett, the future of money, or is it worthless like toilet paper?
Guess what you think my answer will be?
Well,
Worthless.
I just see it as another asset. It's very correlated to interest rates. It's probably cheaper to trade than short-term interest rates. And so I see it just as a barometer of interest rate risk. And it's a really, really cheap way to do that, to access it.
Yeah, I think it's kind of just a speculative asset. And I don't also want to be seen in a public place bad-mouthing Bitcoin, and our Twitter account tomorrow starts getting dunked on. So I think, I was going to leave.
Oh dear.
fair enough, Adam, fair enough. Right, so just before this event actually started, the question that I had here was, it's a bit outdated because we've just received news that Twitter is actually going to open up their books and show the specific amount of bot accounts. So, do you think now the deal is much more likely to be done? And does this excite you? Because we're all Twitter users. We love Twitter. It's FinTwit.
Do we? I couldn't really care either way who owns Twitter, to be honest. I think Musk is going to get forced to buy Twitter one way or another. He's made a legally binding offer to buy the damn thing. He's now realized he's bought Twitter at 20% premium to where they trade now and is trying everything he can to get out of it. But he's not going to win. But I don't really care either way as a Twitter user.
I think it'll be interesting more to see the saga of how it plays out and to see how Musk's financials look afterwards, especially if Tesla dives a lot, because if he is in a binding contract, a lot of his Tesla equity is going to have to be, basically given up, essentially. I think that's how it works. And also he's got different, partners that have gone into the funding round with him as well. So I think that's more interesting rather than who owns Twitter.
I just want to see if he's going to turn the San Francisco HQ into a homeless shelter. That's the only kind of part of it I'm interested in.
Right, the last rapid fire question, and David, this one's specifically for you. Given that you're the director of UK growth at TradingView, so just tell us, Dave, why is MetaTrader a better platform than TradingView?
Speakers fairly wave.
I'm not allowed to answer it.
No, good.
All right. Why is MetaTrader a better platform
than your platform that you work for, TradingView? Yeah, tell us, Dave.
Well, it's not. Come on, everyone knows that. You just have to look at the difference between the two. One looks like it's from 1991. The other one looks like. Yeah.
All right, we've seen the VIX average 26% this year. At the same time, we've seen some outrageous trends in the JPY. Energy markets, the Nasdaq 100 fell 31% from its November high. It's been quite the year. How have you adapted your approach to trade the headlines? And this is we're in the more longest section now, lads.
In terms of stop losses, I've looked a lot more at expected moves, specifically daily expected moves. So rather than, I'm very macro focused, so I tend to have really wide stops anyway. It's more of like a last resort, as it were. I've looked more at kind of trying to pick little bits out of the market rather than holding a position through. And one of the things that I find really useful is if you can find the implied volatility of whichever asset you're using, divide it by 16, because it's the square root roughly of 252, the amount of trading days in a year. That's how you can find the expected daily move. And then you can, work around that. Now, that doesn't mean that it's going to be, exactly that expected daily move every single day. That's just the average between now and the strike price of whichever option you've used to calculate it. So I find taking a bit of a quantitative measure to risk rather than what many do and kind of eyeball and then just chuck up a stop or whatever, works much better in these markets when volatility is a bit higher. You take a smaller position size. Once it starts going your way, that's when you can start adding a little bit more, but always keeping in mind more of a quantitative way of managing risk based on volatility rather than, yeah, as I said, eyeballing and just guessing basically.
Yeah, I think for me, generally, I take a bit of a longer term view on what's going on. The number of headlines we're getting, the volatility that we're seeing intraday, the noise really that we're seeing just makes it even more difficult to have those longer term views and be able to stick to them because you've got all these other tumultuous headwinds coming in trying to throw you off course.
Perfect. Right. I want to go around the table quick and find out what's your favorite macro trade at the moment. Westy, let's start with you.
At the moment, I'm sure, I haven't been prepared. I don't think you can bet against the yen. I don't think you can go long the yen. It is overloved. Sorry, it's underloved. It's oversold. But like we saw in March, the CAD yen was up 14 days in a row. It's up 11. It's up 11 days in a row. So, betting against that in that situation when Japanese life funds are all selling at the moment, leverage funds are piling into, and you've got trend followers all over it at the moment. They're probably max long, but I would be buying any kind of pullbacks in the yen crosses because central divergence is killing it at the moment. So any weakness is a gift, I think, in the yen crosses.
So I'll just very quickly, I quite like short sterling against Swiss franc. I think there's a divergence there. You've got one that's fully priced and that's probably going to have to do a dovish pivot. And the Swissy SNB, they're probably on the trajectory now to increase. They're relaxing their FX intervention. And you've obviously always got the Brexit risk premium perennially always ticking in. And it's very relevant at the moment. And then long US dollar, Turkish lira. I almost said Turkish yen.
If it goes any lower, they'll be calling it that, won't they?
You're all looking at me, so I assume we've scrapped the order. Long dollar, I think the Fed are going to, as I said, keep hiking throughout the summer, probably keep hiking longer than most other G10 central banks. And actually, we're in a slowing global economy. The US economy is performing the best out of what is a pretty bad bunch across the world. And obviously, you've got haven demand as well, because I think risk is heading lower, and that should spark further demand.
Who do you want to play the dollar against, though?
I would just play it against a basket.
Okay. All right. Dave, you're up.
I think does this work? Hello? Oh yeah, it does. Sorry. I think from a bit of a thematic play, looking at long bonds is very interesting, especially with the consideration that, we might be going into a slowing growth environment. Well, we are going to go into a slowing growth environment, and we are already in a slowing growth environment. With QT, there's probably certain idiosyncrasies with quantitative tightening that we have to pay attention to in this kind of short to mid-term. But I think over the longer term, long bond is probably a good way to play it, probably via TLT. And then from a more sort of maybe technical, event-driven perspective, I think German equities are way too overvalued. I don't like German equities at all. And I always like to say, nothing good really happens under the 200 daily moving average, and it's well under the 200 daily moving average. So probably German equities should be offered.
Here
we go.
I'm going to say something controversial which backs up your point.
Oh, right, okay, good.
And you'll probably be talking about it in a second. Euro rates markets are pricing the ECB to raise 130 basis points this year, by the end of December. I reckon they're going to raise by more.
More?
By more.
Yeah, they're meant to do 200 basis points by May next year.
So if you want to, that German banks will probably like that. But
yeah.
Can we just elaborate on that? When do you think they're going to deliver? How do you think they're going to deliver more than that?
He's just pulling stuff out. He's just saying, yeah.
The BOJ are going to hike. The ECB are hiking.
I reckon. We've got an ECB specialist coming on after me, so I don't want to.
Who's that?
I think you're saying at the ECB following exactly what the Fed did back in March. They stopped asset purchase programs. They raised in March. I think the ECB is 6 months behind the Fed, and I think they'll go for a situation where they'll have to start raising 50 basis points in the same way that the Fed are an autopilot now. Big call. Didn't expect it, but there you go.
You're going to be on the front page of the FT now.
The market's pricing in 130 basis points of tights by the end of the year. I think they go more.
I think there's probably someone in Italy having a heart attack listening to this right now.
All right, so staying with the ECB then, 2 months ago was consensus that we'd see parity in the euro-US dollar. Now with the euro-US dollar just shy of 1.07 and the ECB about to start hiking and Westy thinking that we're going to really get aggressive there, is that now looking like a pipe dream parity?
I think if you kind of asked me this 3 weeks ago, which to be fair, you actually did, we literally spoke about it, and this is we literally had this conversation. And at the time, I was pretty adamant that it was. I think it's literally, I think as I kind of went on Skype to you, that's when we actually kind of got that 103.
Zoom.
Is that what they call it these days, the kids? Yeah, 103.
Sorry, I thought I was the
45.
one who's meant to be old.
Yeah. This kind of 103.45 low, I thought it seemed pretty nailed on, but then we've kind of seen this slightly more hawkish pivot from the ECB. I personally think they won't deliver on these rate hike expectations, but I think there's enough of a buffer now to maybe take parity off the table for now.
Yeah, I think that's probably about right. I think that 103.45, 40-ish region is probably going to be the low for now. I think we'll revisit it, but again, I don't think we'll break below it. But I certainly don't think we're getting millions of 50 basis point hikes this year.
Sensing a bit of tension.
Well,
Is it something between
you know,
the two?
what,
We can wager this.
Not after the last wager I had. Who with?
I would say that there's a big risk there because with the ECB hiking, what would you say about spread blowouts? What about if the Bund BTP
Sorry,
spread blows out?
fragmentation, as
Yeah,
Adam
that's
was
what
calling
it's
it
called
earlier.
these
Yeah.
days, fragmentation. Awful.
And it won't be called QE, it'll be called something else. They can't say QE, it'll be just some sort of...
Some other
Yeah.
acronym.
Yeah.
So that's one big risk as to why I think euro parity could actually occur this time, because the ECB haven't been able to hike in what I can't even remember the last time. Was it 8 years ago, something like that, longer, or when interest rates were above positive or something like that.
Yeah.
So, if you want to talk about regime change, that's probably one of the largest in terms of relative movements. So, if there were to be a spread blowout, 10 years ago we had a sovereign debt crisis there. Interest rate risk is probably one of the biggest reasons as to why we could have another sovereign debt crisis.
How would you have said, though, if we'd been at this forum 8 months ago and I said next month the ECB are going to raise 25 basis points, they're going to end asset purchase and they're going to start hiking the cycle? How crazy would that have sounded 8 months ago? Most central banks in most fields.
Well, I mean,
All right, then what are they going to do in 8 months' time now? Then you reckon they'll do? That's what I mean.
well, I actually was asked that about 8 months ago, and I said there's more chance of pigs flying than the ECB hiking rates, and now have egg all over my face. So.
Right, lads, to finish off quickly, last 3 questions. Let's make it punchy and fast. Biggest tail risk for markets?
I think what I've just said in terms of there being a spread blowout in Europe, and that really putting the nail in the coffin for the eurozone, both politically and economically. But that's been said so many times, and it might not happen. But it's a tail risk, I guess.
Yeah. Can we class stagflation as a tail risk, as in a prolonged period of stagflation, 2-3 years?
No.
Okay, fine.
I think there's a bit of complacency around US-China. I think pre-COVID, pre-Ukraine, it's the dominant story. I know we've kind of seen all these stories about potentially some tariff relief, but I don't think it's necessarily a change in dynamic in their relationship. I think Taiwan could potentially be a potential flashpoint. We saw that gaffe from Biden a few weeks ago where he kind of deviated. From
Which one?
Oh, well, yeah.
Too many.
One of many, but the one where he deviated from kind of the policy of kind of strategic ambiguity. I'm sure that was kind of heard loud and clear in Beijing. So yeah, I think that's a potential flashpoint to watch down the road.
Cool. Okay. Second last, Bank of America, and I know you'll love this one, Mike. Bank of America recently floated the idea of the pound turning into an emerging market currency. So will we see the great British peso?
No.
I was surprised Michael didn't actually start taking hostages for the article.
The number of people who sent me that article going, "Oh, Mike, you'll like this. You'll like this. You've been on about this." It's just ridiculous. It's a way for them to get their name in the news. It's not. gonna
Nobody
happen.
loves the pounds more than Michael Brown. That's the one thing you need to take away from
I've
tonight.
got a Union Jack vest on.
All right, lads, to finish off with, just very quickly, if we do see, a central bank mistake and we get a hard landing, the new buzzword, it's gone from transitory and permanent inflation to now soft and hard landing. What is your go-to hedge when the proverbial hits the fan?
Hedges are for gardens. Unless you're running a really big book, I think, and it's a quite complex book, I think that worrying about hedging, especially as a retail trader, is probably quite futile and probably just... Exactly, that's your hedge. It's just getting too complex and you're just going to pay more commissions, which, these guys would absolutely love. But, that's basically what it comes down to at the end of the day. You're running too many positions and you'll just end up getting yourself confused.
I don't trade, so I'll say that's a great answer.
Yeah. I'm going to third that.
All right, that's the end of the panel discussion, ladies and gentlemen, and we now go to the finale. Adam is going to give us his 101 on the ECB, and we're just going to get set up quickly, move this out the way.
Thanks to the lads for the great conversation. Thanks.
Enjoy that.